Hello, very good morning to all, and welcome to a brand new week ahead. I hope that you guys have a great and restful weekend. Very good morning. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Today will be Monday, the 9th of September 2024. So before we jump straight into our gist of today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, projection, prediction in this documentation or in this presentation is not necessarily indicative of the future. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so now, as usual, before we jump straight into our daily dose of market insights, the intraday technical outlook on the broad-based cross asset classes, let's have a recap what has taken shape on last Friday and even in today's Asia session in terms of economic data release, its respective news flow, and the impact of the various major intraday performance of the broad-based cross asset classes. So let's have a recap on what happened on last Friday first. So know that last Friday, the broad-based US stock market closed in the red across the board. So it was a horrendous down move, especially on the Nasdaq 100, which is the higher beta component. But for those who follow our daily dose of market insights last Friday down move shouldn't be a big surprise for you guys, as we did highlight over here. It's pertaining related to NVIDIA, i.e. the AI play that is dragging down the broad-based US stock indices, and the worst hit will be likely the Nasdaq 100 followed by the S&P 500 because they are heavily weighted by these AI related mega cap stocks. So market move in line with our expectation. So on last Friday, the Nasdaq 100 is down was down negative 2.7%. The S&P 500 was down negative 1.7%. The Dow Jones Industrial Average fares slightly better, down negative 1%, because of some of its component stocks are considered defensive, like healthcare, that managed to actually trim its losses on Friday. And the Russell 2000 is down negative 1.9%. So primarily speaking, the reinforcer of last Friday bearish down move on the major US stock indices was driven by the fact of this fear factor that has increased by a notch, that potentially the US economy may be in recession before the Fed starts to cut interest rates. And this is primarily driven by the fear that the Fed is late in the game and the US has really slipped into a recession, i.e. it will be no longer a Goldilocks scenario, but rather the Fed now is engineering its interest rate cut cycle in a potential recessionary phase. So market is actually fearing for this factor that causes the major US stock indices, especially those high beta index as in pretty much since the start of the year, leading the fourth, driven by NVIDIA and the rest of the other AI mega cap related stocks, right now underperforming since July this year. All right, and last Friday, economic data release kind of support this fearfulness of a recessionary scenario that may have already kickstart in the US economy. And why do I say so? By looking at the non-farm payroll data. So if you look at the non-farm payroll data over here, yes, it managed to actually go up above the previous reading of 89K. And before we talk about the previous reading of 89K over here, I want to highlight there's this little R over here. So it was actually revised downwards. Okay, previously, you know that non-farm payroll data, things are, the way they collect data is kind of not in a wholesale basis. So every month thereafter, they will revise the prior month data. So the previous month data was in the month of July was stated at 114k job added, but after the final final collection, the data was revised downwards to 89k, way below 100k, and there's a risk that this 142k data that was reported on Friday may be revised downwards as well, and it also came down below market expectation of 160k. So there is what I call some form of weakness that is being inherent in the headline non-farm payroll data that was reflected or on the data print on last Friday. And also the unemployment rate, more or less, it came in within expectation, 4.2%, but still slightly on the higher level, just only 1 basis point below 4.3%. So if you look at the trend of the non-farm payroll data over here, okay, it's kind of lackluster if you look at it. And if you look at from a percent change perspective as well, all right, nothing that great over here. All right, this is the value. All right, and if you look at the unemployment rate, okay, it still continues to remain relatively high in terms of a trending perspective. All right, over here. So what we could see over here, that means it actually increased the risk of a, we call it a growth weakness, or I will say that higher chance that the US economy may have already slipped into a recession. And there are actually right now market participants will be focusing very closely on growth related data rather than inflation related data, because we know that inflation related data more or less is on the path of deceleration from 2 years ago, and the Fed has already more likely acknowledged that it's time to actually kickstart its interest rate cut cycle by Jerome Powell Jackson Hole speech at the late August. So now market will be now focusing on more growth related data rather than inflation related data. So later I'll share with you all what are these data to look out for as we progress every day from our daily dose of market insights. Okay, and one more data I'd like to share with you all over here is pertaining to China. So in today's Asia session, we do see the release of inflation rate data up from China, and the data has been pointing to the weaker side of a deflationary scenario in China increasing as well in terms of the probability. Why? Because data inflation year-on-year data continue to inch downwards, 0.6% from 0.5% that was printed in July, and slightly below expectation of 0.7% that market is expecting or being forecasted to come in. So if you look at the inflationary rate in China, okay, it's also okay. Over here, let's go to the 5-year trend. Okay, this inflation rate is also kind of lackluster, can't go above 0.7% that was printed in February, and continues to trend underwater 0.7%. And what's interesting over here is that there is this feed-through effect from factory gate prices. That means what producer are being paid. If the producer are being paid lesser in terms of the price, it will actually fill into the cost of goods for the consumer as well. That means there is this negative feedback loop from PPI. This is called factory gate prices. So PPI prices, that is what we call it producers prices or producers inflation, also has been inching downwards as well. So market previously there was showing some signs of recovery, negative 0.8%, but right now in August, it managed to slip much deeper to negative 1.8%, below, way below market expectation of negative 1.4% for the month of August. So if you look at the PPI trend over here, okay, previously there was some signs of improvement. Okay, previously there was some signs of improvement. Okay, market intending to actually go up, all right, in the period of from February this year all the way up to June. Okay, so there's some signs of we call it at the end of the very dark tunnel for this deflationary scare in China to end. by this leading PPI change, or the PPI producer prices. But surprisingly, the PPI prices, or the producer prices, or we call it factory gate prices, continue to slip downwards again to negative 0.8% year on year in August. So it seems to us that this previous movement of recovery is now losing steam. So that is the big risk, that the China economy is now showing increasing odds of a deflationary spiral being inflicted into the economy, and that potentially also add on to another engine of growth. That means, you know, that global economy is at the point in time, these are the two largest economies so far, US and China. And with these two major economy that is showing signs of lackluster growth, US potential risk of recession, and China now showing not even potential risk of recession, but rather risk of a persistent deflation. So that for sure doesn't gel well to the global economic growth, given that these two are the biggest economy globally right now. And eventually it may also not see any what I call rosy a positive feedback loop into the risk asset classes from a medium term perspective. That means, i.e., global equities from here. So that means, i.e., we're talking about from a multi-week to a multi-month perspective, global equity may not be hovering in a major uptrend phase. If we look at the market leader, will be the major US stock indices from here. All right, so this is something I want to express for you guys in the based on the current intermarket and based on the current economic data and news flow that we are seeing right now. All right, so now let's look at the heat map of the S&P 500. So you look at the heat map of the S&P 500, it closes entirely in the red, almost in the red. I would say there are some pockets of green in the defensive, like healthcare, real estates will be REITs, and as well as some of the consumer staples. We call it the consumer defensive over here. But this particular sector, these particular three sectors are very small in terms of weightage in the S&P 500, so they can't actually help to allow S&P 500 to close in the positive territory on Friday, because it's being dragged down by the mega cap technology stocks, and in the technology sector. Very weak in Nvidia, which I really highlight to you all in last week daily dose. You can actually take a look at it. Why Nvidia is weak, and why Nvidia is the key component stocks that could actually drag down the S&P 500 and the Nasdaq 100, not from the multi-week perspective, and as well as from a multi-month perspective. And we start to see weakness in the communication services sector as well. Google and Metal both all close negative 4% and negative 3.2%. Apple slightly better, negative 0.7%, because of this upcoming optimism of a kind of, ahead of Apple major conference that's going to take shape. I believe that later I'll share tomorrow also regarding about, later I'll share when will be the exact date of at the Apple conference. Yeah, they're going to take shape earlier this week, that they will showcase their latest product. So that managed to actually kind of decline as a lesser magnitude compared to the rest of the other mega cap stocks. So if you look at the, okay, 1 second. Okay, let me go up. So if you look at the sectorial performance basis over here, so from a sectorial performance basis, okay, so let me expand it so that you guys could see bigger. Okay, hopefully this is as large as it could get. Okay, maybe let me expand it some more. Okay, this should be big enough here. So this is the one day post on last Friday. So what you could see over here is that the real estate, the consumer managed to actually fare much better. Okay, and from a 1 week performance, the consumer defensive, which the consumer staples, and the real estate, which consists of REITs, managed to actually gain 0.8% and 0.6%. A slight gain for utilities, also a defensive sector at positive 0.11%, because these three guys has very small weightage in the S&P 500, which I actually shared with you earlier. Despite them being outperforming the market, but they can't actually allow S&P to close in the green, because S&P is heavily weighted by the technology sector and the communication services sector, both of them down -5% and -6% for last week, okay, due to the heavy weightage of the technology mega cap stocks. All right, so now with that, let us now shift our attention to the fundamentals and as well as the intermarket dynamics on share with you. So if you look at the CME Fed Watch 2 over here, so let me expand it. Okay, so this is based on the latest data that we have compiled by CME group. They call it the CME Fed Watch 2, that allow us to gauge what are the current odds right now based on the pricing of the 30-day Fed funds futures that the market is expecting, whether how much will the Fed cut or hike in the respective upcoming FOMC meeting. So we know that the next meeting coming is very soon, 18th of September. So I will not touch more about this meeting. I'll cover more about that next week, all right, because we do it on a daily dose basis. But for today, I want to share with you what is the current pricing that is being priced by the Fed funds futures market, all right. So current rate of the Fed funds is at 25.25% and 5.5%. So after last Friday key economic data release, which is the NFP data, nothing has really changed much compared to a week ago. So market is still looking at around 30% chance of owning a 50 basis point cut, but more skewing towards a 25 basis point cut in first step first at 71% to bring it down to 5% to 5.25%. All right, the range over here. So if you look at from a aggregated perspective, all right, so in this aggregated perspective, the CME Fed Watch 2 allow us to have a slew of aggregated meeting probability across the calendar down forward looking. That means from 19th of September, that ahead what the market is looking at for 7th of November and 18th of December, and even all the way down to next year as well. So we know that market is now looking at a 25 basis point cut in the 18th of September meeting with a high odds of 70%, okay, about 70%, which I actually highlighted to you earlier. Then if this really plays out as true, the next one market will be looking at will be a 25 basis point cut, but only 17% to bring it down to 4.7% to 5%. Market is expecting a bigger cut of 50 basis point right after the US presidential election from 5th of November, because US presidential election will be on 5th of November, then 7th of November will be the FOMC. So at the 7th of November FOMC, market is expecting a 83% chance of a 50 basis point cut to bring it down to 4.5% to 4.75%. And thereafter, what market is expecting is another 25 basis point cut, all right, to bring it down to 4.25% and 4.5%. Why? Because it's a 50% chance, slightly higher than another 50 basis point cut. Okay, so I would say this one is about a coin flip, 50-50, but we still respect the current price action. So we choose the 50% one. So on 18th of December to bring it down to 4.25% and 4.5%. So what market is now looking at is before 2024 ends, overall, they are expecting a 100 basis point cut in the Fed funds rate. That means 1% cut in the Fed funds rate to bring it down to 4.25% to 4.5% on the 18th of December 2024 FOMC meeting. So based on this current pricing over here, market are still kind of looking for one jumbo interest rate cut, 50 basis point cut, to come in the November meeting. That means there is a slight pricing odds of a recession risk that may have already occurred in the US economy. And with this kind of recession fear that is being priced into the Fed funds rates right now, calling for a jumbo interest rate cut in the November meeting, the market breadth of the US stock market is also getting pretty lackluster as well. And that doesn't also supports the bull market from a medium-term perspective and as well as a multi-month perspective. And if you were to look at the current market breadth on the 20-day and the moving day, 50-day, that means we're looking at these two key major US indices, the NASDAQ 100, the higher beta one, and the S&P 500. All right. So if you look at the percentage of NASDAQ 100 stocks that are above their 20-day MA has really slipped dramatically, around 80% since the start of this month, now it only show 26% as of Friday. All right, that means i.e. there are lesser and lesser stocks within the Nasdaq 100 that is still holding above their respective 20-day MA. So only a small portion of them, 26%. And even the 50-day moving average, it has slipped down from the start of the month at around 65%. Now it only shows 39% as of last Friday. All right, so a significant portion of stocks in the Nasdaq 100 is also holding not well, put it away, very little percentage of stocks in the Nasdaq 100 are holding above their 50-day moving average. So that's not a good sign as well on the Nasdaq 100. And even the S&P 500 now, previously it was at 50% plus, all right, and right now as of last Friday close, it's now hovering below 50% at 43% for the percentage of S&P stocks holding above their respective 20-day MA. And their breadth for the 50-day moving average means the percentage of S&P stock above their 50-day moving average. Yes, it's still above 50%, but it has gradually significantly reduced as well from the start of the month in September, okay, at around 76%, and now it actually has significantly slipped to 58% as of last Friday. So the number of, I would say that the percentage of S&P stocks holding above their 50-day moving average has significantly been reduced as well. So net, what we could see over here is that the market breadth from a medium-term perspective and a multi-month perspective by looking at the percentage of component stocks holding above the 20-day and the 50-day moving averages for the Nasdaq 100 and the S&P 500 is bearish rather than bullish right now. All right, so this is the current fundamentals, which is based on the what market is pricing in the up and coming interest rate cut cycle as depicted by the CME Fed Watch 2. There is risk of a recessionary scenario taking shape, and with this risk of a recessionary scenario taking shape, it has been transpired or transformed into a rather lackluster bearish market breadth movement or condition as being expressed by the percentage of component stocks for both the S&P 500 and the Nasdaq 100 that are trading above the 20-day and the 50-day moving averages. All right, so with that, let us now shift our focus to the intraday technical outlook, starting with the FX market. But before that, let me expand my screen first, okay, so that you guys could see. Okay, 1 second. So hopefully, I think my screen is hanging at the moment. Okay, so hopefully it's, yeah, I think it's good right now. Okay, hope that you guys could see everything. Okay, so now let us start with the FX market. All right, starting with the FX market with the euro dollar. So the euro dollar on last Friday, we do mention a first resistance level. It got to clear at 111.40 before having a chance to revisit the 23rd of August minor swing high at 112 figure level. So it hit on Friday upon the release of the non-farm payroll data. Then thereafter, it's getting lackluster and didn't surpass above it, and now trying to break below the 20-day moving average. So all you could see over here is that based on last Friday intraday negative reaction of the 1140 level on the euro dollar, and as well as the hourly RSI that has broken down below a minor trend line support level, it has now come to us based on the current intraday price action of euro dollar. It seems to be exhibiting intraday bearish momentum. Okay, so allow this price was intraday bearish momentum. All right, the medium term trend is still up. Why? Because it's still holding above the 50-day moving average. But right now on the intraday basis, the momentum has started to turn weak by the negative reaction of the 111.40 level, and as well as the bearish breakdown of this parallel ascending former ascending trend line as being depicted by this dotted red line shown on the hourly RSI on your screen over here or on my screen. So with that, I'll be using 111.40 as my short-term pivotal resistance for today. We will flip to a intraday bearish bias on the euro dollar. Near-term support level to watch for today, 110.26. A breakdown below it exposes 110 figure, maximum 109.50, which correspond to the rising 50-day moving average. Only an hourly close at a break up above 111.40 will invalidate today's intraday bearish bias to kickstart the continuation of this, we call it a minor uptrend phase, to revisit 112 figure level and even 112.35 next. All right, that's for the euro dollar. And with the euro dollar showing weakness on the intraday basis, we will be less optimistic on the sterling dollar for today. So for the sterling dollar, very same for the euro dollar. Last Friday, it failed to break above 131.90. Then thereafter, it reintegrated back below 131.90. So with that, but it's still holding above this rising 20-day moving average, I think as a coming to as support at least 130.80. So with that, we will have a neutrality stance on the sterling dollar for today, neutral between 131.90 and 130.80, right, between these two range. Only a breakdown below 130.80 will validate a intraday bearish bias on the sterling dollar for the next near-term support level to be exposed at 130.40/130.10. Below it sees the next near-term support coming in at 129.40, which will correspond to the rising 50-day moving average as well. Okay, so that's for the sterling dollar. So with that, let us now shift our attention to the Asia Pacific currency against the dollar, starting with the Aussie dollar. So Aussie dollar, still recall last Friday, we do have a bearish bias right below the 75 figure level over here, hit our support level before now trying to do a push up right exactly at the 50-day moving average, and the hourly RSI has now just exited from the oversold region. So with that over here, I could be using this as a first support level for today. Okay, around today's Asia session low at this 66.67, but I want to push it slightly lower at 67.40, which is this former minor swing high area over here, now turns into a pullback support level. Okay, so as long as this 66.40 short-term pivotal support holds, there could be a potential chance of a intraday bounce coming into the Aussie dollar, given the fact that last Friday it has a dramatic sell-off that led to a oversold region on the hourly RSI, and the hourly RSI has just managed to exit from the oversold region over here. And what's interesting over here is that it starts to shape a bullish divergence as well. Okay, a bullish divergence. So with that, it gives us more prudence for this or higher odds of this potential minor rebound scenario to play out. So we will flip to a intraday bullish bias for today on the Aussie dollar using 66.40 as my short-term pivotal support level. First near-term resistance level to watch will be at the 20-day moving average, now acting as a resistance at 67.10. A breakout above 67.10 exposes 67.60/67.75 next. If you look at it from a Fibo retracement perspective, taking on this ongoing decline from the high of 29th August all the way up to the last Friday US session intraday low, that also correspond to the golden ratio as well at 61.8%. Okay, only an hourly close below 66.40 will invalidate today's intraday bullish bias to see the continuation of the impulsive down move to expose the 200-day moving average, also confluencing with this graphical support zone at 66.10/66 figure level. Below 66 figure level exposes 65.70 next, which is the minor swing low of 9th of August and 15th of August. Okay, so that's for the Aussie dollar. Turning our focus next will be on the dollar yen. So the dollar yen also came down as expected, hit our the support level at 41.60, 41.40 level, and that's the first support. The second support is at 140.25. So 140.25 over here is somewhere around, it's the graphical support level, the swing low of 28th of December last year. And what's interesting over here is that it revisited the 5th of August low, all right? And after hitting that close to the 5th of August low, the RSI also shaped that bullish divergence as well, or a very clear bullish divergence exit from the oversold level. So with that, there's also an increased odds of at least a form of minor rebound scenario taking shape on the dollar yen. So with that, I will use 141.60, 141.40 as my short-term pivotal support level for today. Flip to a intraday bullish bias for this potential mean reversion rebound scenario to play out. First resistance level to watch 144.30. Above it exposes 145.40 slash 145.90, which will confluence with the downward sloping 20-day moving average. And as well as if you do the Fibo retracement of last week's sell-off all the way to last Friday low, that also correspond to the close to the golden ratio of 61.8% and 76.4% on the 145.40, 145.90 level. Only an hourly close below 141.40 will invalidate today's intraday bullish bias to see the continuation of the impulsive down move to expose the next near-term support level at 140.25 in first step. A breakdown below it may see a deceleration down move towards 137.70 slash 137.35 next on the dollar yen. All right, so with that, now let us now shift our focus now to the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33, it was closed on last Friday due to typhoon, even during the normal Asia trading session, and as well as the European and the US session. So very naturally today it gapped down and hit our support zone level at 1727 slash 17185. Okay, this support zone has been hit over here, so let me remove it. And right now it's attempting to actually play around the 200-day moving average, and given the fact that the hourly RSI has already starts to actually hit the oversold region over here, and very closely every time it hit this oversold region, okay, there are signs of a rebound in the past. Okay, over here on the 5th of August there's a rebound, and previously over here on the 4th of September, there's a minor rebound taking shape. And if we do the Fibo retracement, taking from the previous rebound or the recent rebound for 5th of August low all the way up to the high of 30th of August, the price action right now is hovering very close to the golden ratio at 61.8%. So with that, we will use a slightly lower short-term pivotal support for today, which this clear graphical minor swing low area of 9th of August and 15th of August at 16,690. So using 16,690 as my short-term pivotal support for today, we will flip to a intraday bullish bias for today. For now, given that it really now it's testing the 200-day moving average, positive element that's being depicted on the hourly RSI, at least for a minor bounce scenario to unfold on the intraday basis. First resistance to look out for will be at today's gap down level, which is a gap resistance, forming a gap resistance right now at 17,330 level. Okay, 17,330, which is also very close to today's intraday Asia session high at the moment in time we are speaking. So only a surpass above 17,330 may give more credence for the minor bounce to extend to retest 17,500 slash 17,595. We also confluence with the 20-day and the 50-day moving average, I think, as a similar resistance zone as well over here. However, if the price action instead fails to bounce and it starts to inch downwards and have an hourly close below 16,690, then today's intraday bullish bias scenario will be invalidated to see the continuation of this impulsive down move to expose the next near-term support level at 16,716 next. All right, over here, which is the minor swing low of 8th of August. So that's for the Hong Kong 33. Now moving on will be the Japan 225. So the Japan 225 also plummeted down and hit our support level at 35,860, and right now it's coming close to the 50% Fibo retracement of this entire up move, the entire we call it a bounce from 5th of August all the way up to the high of 2nd of September. And also the hourly RSI has already exit from the oversold region, so indicating to us that last Friday dramatic sell-off may lead to a mean reversion rebound scenario. that could unfold on the Japan 225 on a intraday basis. Okay, so with that, we will flip to a bullish bias for today on the Nikkei 225, the Japan 225, using 34,720 as my short-term pivotal support level, a breakout above 35,860, which the price action is testing right now. That was this previous former minor congestion support zone over here, now turns to the pullback resistance. A breakout above it increase the probability of this mean reversion rebound to expose the next near-term resistance level, coming in next at 36,540, followed by 37,170, which is right below the 20-day and the 200-day moving average, acting as a resistance level. However, if price action starts to come down and break below 34,720 with an hourly close below it, then this intraday bullish bias scenario will be invalidated for today to see the continuation of the impulsive downward sequence to expose the next near-term support level at 33,985. Below it sees 33,107 next, which is the minor swing low of 6th of August over here. Okay, so that's for the Japan 225, i.e. the Nikkei 225. So with that, let us now focus our attention to the one of the major European stock indices. So the major European stock indices also, which is the German 30, that we highlight in our daily dose almost every day. It came down and hit the support level at 18,350. All right, 18,350 mark, and right now is coming very close to the next support level at 18,160/18,075, which is this former congestion zone over here. Broke down, break, now coming to cat again. And if you will do the Fibo retracement of the entire move, the prior move, from prior up move, I would say from 5th of August low all the way up to the high, this is at this 3rd of September, it also corresponds very closely to the 50% level as well. Okay, so with that, given that this level has already been met, 18,350, so I'll be using this 18,160/18,050/075 level as my short-term pivotal support level for today, looking for a potential mean reversion rebound scenario to unfold on the German 30 index. First resistance level to watch will be at 18,470, which correspond to the 20-day moving average that is acting as a resistance level, and above it may seize last week swing high area at 18,660 next, coming in next. Only a breakdown below 18,075 with hourly close below it, 18,075, will invalidate today's intraday bullish bias to see the continuation of the down move in the German 30 to expose the next support level that is also confluencing with the key 200-day moving average at 17,820. Okay, so that's for the German 30. Now, shifting our attention to the major US stock index, which is the US Wall Street 30. So the US Wall Street 30 last Friday, we were neutral. It broke down the neutrality range and hit the support level at this very close to that 40,200 level, and also the 50-day moving average as well that is acting as a support before staging a bounce in the later part of the US session. All right, and in today's Asia session, it managed to slightly recover right exactly at the 50-day moving average. So with that, I'll be using 40,140 as my short-term pivotal support for today. All right, and given that the RSI also starts to bounce up from the oversold region as well over here, and it also starts to show a bullish divergence. All right, okay, a higher low over here. All right, okay, a slightly higher low where price action shape a lower low, and with this slight bullish divergence that's being depicted on the hourly RSI, there is some signs that last Friday downside momentum is being overstretched, and there could be a chance of at least a mean reversion rebound or a minor rebound scenario at least to unfold first in first step of the US Wall Street 30 as the price action still indicate that the medium-term uptrend still remains intact, given the current bounce that we are seeing right now at the 50-day moving average, and the 20-day is still holding above the 50, is still trading above the 50-day or still above the 50-day moving average. So 40,415 short-term pivotal support on the US Wall Street 30 flipped to a short-term intraday bullish bias for a potential kind of a mean reversion rebound scenario to unfold first in first step. First resistance 40,610. A breakout above this level may see 41,040 slash 41,200 next. And if it was this level in terms of the Fibo retracement taken from the current all-time high here, all the way down to last Friday low is actually the golden ratio as well, 61.8%. Okay. However, if price action starts to come down and break below 40,140, then with an hourly close below it, that will invalidate today's intraday bullish bias, and as well as damage the medium-term uptrend of the US Wall Street 30, and that could actually kickstart another round of impulsive down move sequence, at least in first step, to expose the next near-term support level at 39,867, followed by 39,580 on the intraday basis. Okay, now lastly will be the Nasdaq 100. So the Nasdaq 100 last Friday we were bearish because of its much more lackluster technical configuration as compared to the Dow Jones Industrial Average. Came down and hit the support level at 18,320 before shaping a bounce in the later part of the US session over here. So with that, and also come very close to the 200-day moving average as well. So I'll use a slightly lower pivotal support level below 18,320, 18,165. So using 18,165 as my short-term pivotal support for today, which is very close to the 200-day moving average, flip to a intraday bullish bias for the Nasdaq 100 for today, for looking for at least a mean reversion rebound scenario to play out on an intraday basis. First support zone, first resistance zone level to watch, pardon me, will be at 18,680, followed by 18,800. Only a break above 18,800 may retest last Friday minor swing high at 18,935 on a intraday basis. Okay, this is the next resistance level to watch. However, if price action starts to break down below 18,165, then that will invalidate today's intraday bullish bias. That means forget about the mean reversion rebound. That is where we could see the continuation of the impulsive down move on the Nasdaq 100, dragging it down further towards the next near-term support level at 17,960, followed by 17,750 on the intraday basis. Okay, so with that, that sum up the intraday technical outlook on the major stock index. Follow up next will be on the commodities market. So over here, let us focus on the gold first, XAU/USD. So gold as usual continues to push out on last Friday, but it failed to break above the 2,532 level, which is a minor range scenario right now. Also correspond to the current all-time high that's being seen, current all-time high area that's being printed on the 20th of August. So no change, still using the 2,473 as my short-term pivotal support. First support level will be around the 2,493 level, where price action came down on last Friday and managed to stage a bounce of it right now, which is very close to the rising 20-day moving average as well. But this level is a bit tight, so I will use the minor range support level that is in place since 22nd of August at 2,473 that has been tested on the 3rd of September. It survived, and it managed to survive again on the 4th of September. So for sure, this is indeed a key short-term pivotal support for gold in order for the bullish bias to maintain its trajectory. So using 2,473 remains as the short-term pivotal support, still having a potential short-term intraday bullish bias on gold XAU/USD, but however, it got to have a clear break above the 2,532 intermediate range resistance level to increase the odds of an impulsive up move sequence to expose the next near-term resistance zone of 2,588/2,595. However, if price action break down below 2,473, that means with an hourly close below 2,473, that would invalidate today's intraday bullish bias to kickstart another leg of minor corrective decline to kind of revisit or expose the next near-term support zone of 2,435, pardon me, /2,415, which is corresponding to the rising 50-day moving average. So that's for gold XAU/USD. And one thing positive is that the hourly RSI has managed to hit the oversold region on last Friday, and right now showing signs of positiveness as it managed to inch up from the oversold zone. Now, with that, let us now turn our attention to West Texas crude oil. So WTI last Friday, we do have a bearish bias, and the bearish bias hit our support level at 68.20. So this 68.20 also corresponds to the 1.382 Fibo extension level and the lower limit of this minor descending channel that is in place since the high of 18th of July. And with that, the hourly RSI also starts to inch upward as well. So there could be some signs of a mean reversion rebound taking shape on West Texas oil again. So using a 68.20 as my short-term pivotal support level for West Texas oil, flip to a intraday bullish bias for today for that potential mean reversion rebound scenario. Near-term resistance level to watch will be at 71.15. A breakout above it exposes 72.20/73.15. So this one is a former key medium-term range support, now turns into a medium-term range resistance, which is this dotted line here, which is the former major symmetrical trend line support that was in place since December last year, now turns into a medium-term pullback resistance zone. Okay. However, a price action, instead of inching upwards and it starts to break down again below 78.20 level, it break down below 78.20, then today's intraday bullish bias will be invalidated to see the continuation of the impulsive down move on West Texas crude oil to expose the next near-term support level at 67.55/67 figure and potentially even 65.10 as well. Okay, so that sum up the intraday technical outlook on the major cross asset classes. So before we go, let's have a quick look at the calendar. What are the key economic data to look out for? All right, so in the European session, so European session, nothing much over here, and even the US session as well is rather quiet. So what we could see, let me make sure, yeah, correct, it's rather quiet. So tomorrow, early Asia session, we do have two key Australia data to take note of will be the business consumer confidence at 8:30 a.m. and followed by business confidence at 9:30 a.m. in Australia. That could potentially impact the Aussie dollar. And before we go, let's have a quick look at where is the Apple event, the date of the Apple event. Okay, so the 16th event. Okay, it's 10th of September. Okay, so basically, right, the Apple event will be today's US session, but in Singapore time will be at the 10th of September at 1 a.m. Singapore time. So also something to take note of. Why? Because this particular Apple may cause a bit of fanfare, and that could see a bit of, we call it a consolidation after last Friday dramatic sell-off in the Nasdaq 100, and given that Apple itself is the biggest weightage cap in the Nasdaq 100. All right, so with that, that sum up today's daily dose of market insights. I'm Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.